transiting nicely. Yeah. Good afternoon, everybody. Welcome to the IEA webinar on this case for UK property. We will begin in 5 minutes time. Good afternoon, everyone. Welcome to the IEA webinar. Today, we have come and bring together 3 experts in the field of foreign property marketing and transaction in the UK market. In fact, all the 3 of our distinguished speakers, they actually come together. They have easily more than 70 years of experience among them. And today we're going to hear from them, from their view, their expert point of view, and their experience that they're going to share with us, and to bring together, hopefully that you can bring home with you. So let me check. Okay. Oh, man. Okay. So hopefully that you can take home something with you from this experience, whether you are a practicing agent or you are going to become an agent, or you are actually someone who want to invest in UK, London market. Now, these are the people you can actually later, but please come in and submit your question to me, or you can actually ask them on the chat itself. So don't let them go away, okay? Easily, make sure you get something from there. Now, allow me to start by sharing a bit of IEA with you. Okay. Now, as you know, IEA have been formed since 1988, and we are still around. And we are actually formed by the estate agents. We come together, and then we are doing this for the estate agents. So all the council members and the members who are helping the in and outs, the things to do daily, they're actually giving up their own time and space, and actually they are providing what they call a payback sessions to the industry that have helped them over these years. So if you are not a member yet, we urge you to come forward and join us. All right. You see this little logo sign here, a photograph. This is where you can take a picture. So now in IEA, what can you actually expect? Of course, other that there are two main pillars here. One is members activity. One is more on education, is continuing education and training. So this is what we're providing. We're providing the RES, which is for people who want to become a real estate agent. And at the same time, we also provide them revision classes, graduation party, so that to get them absorbed into this industry together. And when they become one and continuously they will do their professional development, they can also register with us. And on top of that, we have gathering session, we have WhatsApp chat group, we have Telegram chat group, we have FB to stay on the ground to connect with all agents. Okay, we have gathering sessions, something like this, or sometimes even more informal. The more informal one we call La Kopi. I mean, for the sake of our distinguished speaker, this is a coffee time, you know, where we actually meet up physically, and it's every first Tuesday of the month. At the same time, we are also organizing few trips, some we have locally, some overseas. Later, I'll tell you more about that. And also take note, we have free legal clinic advice from our friends of IEA who are they are actually providing some free legal advice. So do book this early with our administrator so that we can allocate the time for you. At the same time, this is what we are doing today. It's also in line with what we are doing. We are conducting a certificate course in marketing of foreign property, and which is in this case, we are also doing this to help our agents who want to transact property in Singapore, on foreign property in Singapore, so that they have a better grasp of the market situation overseas. So at the end time, almost every week, every day, we have activity lined up for you. All right, you can look at all the second Tuesday of every month, third Wednesday of every month, and so on, so forth. And at the same time, we also organize visit. These visits are mostly all full board paid, except for your air ticket. So like the coming up one, which is end of this month, we're going to a weekend trip to Cambodia. Right? So book your ticket fast and book your place with our secretary. Right? And next year, we are looking to go into Philippines. In fact, we feel that Philippines is another area of growth that we should look at very soon. And we're going to have two sessions, one in Cebu and one upcoming is Manila. Now, IEA also not just stay within Singapore, we also have block network across other countries. We have block network with the USA, NSR. At the same time, in Asia, we are very strong. In fact, we are one of the founding members of this body called ARENA, ASEAN Real Estate Network Alliances. So here we can even reach out to lawyers, accountants, agents, and on and off, we have every year we have come together. Each country will take the role of leading and then and start a conference in the respective country or cities. So with this, we tied to today's session, we are actually tied to the course that we're coming up end of the month. It's a 5-day course, 3 hours per day, and then followed by a 90-minute assessment. Now, this is what we call the certificate course in marketing of foreign property. You can actually access to your skill future credit as well as your UTAP to bring down your price. Right? So the course itself includes countries such as Indonesia, Malaysia, Thailand. In fact, we go all the way to New Zealand, Australia, and UK, which is what we are talking about today. And we will incorporate all the law, rule, regulation, tax, and mortgage and transaction procedures. Now, without further ado, today we want to present to you UK London. So our three speakers here will focus on how best you can get a deal out of the London and what is the current situation today. Now, I would like to introduce to you one by firstly, Richard will start off. He will give you the area on the scene, the market situation in the UK market. Now, for Richard, I know him for quite a long time. This guy is actually from UK himself. He's from Oxford, I think, in London, and then he has been staying in Singapore for the past 20 over years. And he has been heavily involved in all his UK projects. In fact, I think anybody who have any idea of how you want to go about purchasing or listing property in UK, please go to him. His number is attached there. You can see a camera sign here. You can snap a picture from this slide. And then next, I also bring Bianca. Bianca, I get to know her recently, but I know she's from GetGround. This is what you call a company that help you to get the best out of your deal when you purchase a property. So this is a lady that you don't want to miss. Okay, please pick down her number and get in touch with her as close as possible, because she is going to help you to get the deal. If you have customers who have difficulty in getting deal and trying to find the best way to purchase property in UK, especially in London, go to her. And Scott is your man that you're going to go to when you talk about financing. All right. So make sure this is a very good time to look into financing, because you need someone to help you to get how to manage your finance, how to get the best the mortgage broker that you can find in the market. So Scott is the one man that you're going to go to. So without much ado, I will pass the session over to, okay, before that, if you have any question, you can leave them in the question box. And at the end, you have any feedback, you can just write to us. But otherwise, the session will be run, we will start off with Richard, and then followed by Bianca. And then after that, Scott will finish off, then we will have Q&A. So Richard, it's all yours, take over.
Okay, thanks very much. Let me just share my screen. Okay. Okay, just bear with me one moment. Okay, can I just get a thumbs up that you're able to see my screen at the moment?
Yes, sir.
Okay, lovely, great. Well, thanks very much again, Sam, for the introduction, and welcome to all those attending today. Again, my name is Richard Lowe. As Sam mentioned, I'm originally from Oxford, England, but I've lived in Singapore now for 27 years. And I like to think that I can hopefully bring the best of both worlds, having lived in Singapore for a long time and invested in property both here in Singapore as well as the UK. I'm presently director of One Global Expat, and we help clients from all over the world access overseas property markets, but particularly strong in the UK. Today, I know I'm speaking to a lot of real estate agents, but we also have some clients on the call today who wanted to learn more about the UK and London property market. So again, welcome to all of you that are here. Really, what I want to do just to kick off is give a little bit of background to what's happened in what's been quite a tumultuous few years through COVID. If we go back to the end of 2019, when Boris Johnson and the Conservative Party won a landslide election, and soon afterwards, Brexit had finally been done, the beginning of 2020 spelt a very encouraging time. And what we started to see in the real estate markets after being a little bit subdued with all the Brexit shenanigans was real buoyancy in the market, prices increasing, and activity really picking up. And then towards the end of the first quarter of 2020, COVID hits. And many of the analysts were predicting that the world would go into a recession. And as part of that, real estate prices around the world would plummet. And for the UK, analysts were predicting somewhere between a 5 to 7% decrease in property prices in 2020. And when we look back, how wrong could they be? And you'll see as I go through part of this presentation, what's been happening in the UK, certain parallels with what's happened here in Singapore as well. But when the UK went into its first lockdown in spring of 2020, many people were starting to rethink what do they need from their property. And like a lot of places around the world, people wanted to upgrade to a bigger property that might have an extra room for a home office. If they're living in apartments, having access to a balcony or some kind of open space that they can access in case they are having to be staying in lockdowns for extended period of times, or close to open parkland. So there was a big shift in what people were looking for. In July of 2020, the government introduced a temporary stamp duty holiday that saved up to £15,000. And combined with the lowest interest rates in over 300 years, what actually resulted was a huge increase in people upgrading their property, taking advantage of stamp duty holidays, locking into the lowest interest rates since records began. And with less property coming on the market because a lot of construction workers couldn't get on site, planning permission departments having staff on furlough just exacerbated the supply-demand deficit. And as a result, we've seen prices literally just rocket and go up faster in the last 1 or 2 years compared with almost any other time in the last 2 decades. Now, this slide here just gives a brief snapshot of February 2022 to February, going back to February 2021 of different regions around the UK and the average price within these regions in terms of the capital growth. Now, depending on what snapshot you take, Halifax Building Society, which is owned by Barclays Bank, one of the biggest lenders in the UK, released their results in June of this year, stating that the average price of a property across the UK went up by 13.2%, which again is quite phenomenal. In fact, in just the month of June alone, the average price of property in 1 month went up by 1.2%. People, were assuming that prices of property were going to start slowing down with increase in interest rates. And I've got a few slides that are coming up really just to address some of those concerns and issues. When we look at this slide, we are going to be focusing in on London. And it's interesting that although London increased on average on this snapshot by about 8%, which is a phenomenal capital growth rate in any normal time, it's actually the lowest of all of the different regions in the UK. And I think people need to understand how London operates, especially when we look at prime central London. And what I mean by prime central London is zones 1 and 2. And for those of you not familiar with the zones, think of zone 1 like a bullseye of a dartboard. And zone 2 is the next concentric circle outside of that, and zone 3 and zone 4, getting out to zone 6, which would be out towards Heathrow Airport on the outskirts of Greater London. So what we see with prime central London is it's heavily driven by high net worth overseas investors. However, during the COVID times, travel was virtually impossible. But what we are starting to see is as the UK and many parts of the world open up travel, as those international investors are able to travel there, we're starting to see a really exciting time in London, particularly prime central London, which I'll go into in more detail in just a moment. Now, next slide, if it's going to seems to be a bit of a lag. I'm trying to get through to the next slide. Okay, that's interesting. Okay, my screen has locked. Let me just stop sharing and I'll go back into sharing. For some reason, it's not sharing. Okay, apologies for this. Let me try sharing again. Go back to this one here.
Yes, it's working.
Okay, sorry. Yeah, it was a bit of a lag there. Okay, I hope we're back in business. So this is an interesting bar chart that actually shows basically what happened before pre and post pandemic, and effectively what are people putting a higher priority on when they choose to either buy or rent a property. And we can see here that 70% of respondents put energy efficiency and running costs as one of their top priorities. And we know that with fuel prices going up, this is becoming a real burden to many household families in the UK. And so, you know, it's actually got the highest rating. Private outside space and space for a home office rank very highly. Prior to COVID, two of the top things that people prioritized were, one, access to public transport, and two, proximity to their work. And we'll see that, you know, these come much lower down on this bar chart here. Other things such as broadband speed, storage within the property, proximity to green spaces and parks, level of the service charge, which effectively is the maintenance fees in the UK, proximity to public transport, electric car charging points, and quality of restaurants and pubs in the area. Pub culture is a big thing in the UK. Okay, the exchange rate. You know, again, I've been here 27 years. When I first arrived in Singapore in July of 95, it was roughly 2.6 Singapore dollars to the pound. I remember in 2007 selling a property in the UK when it was 3.15 Singapore dollars to the pound. If we look towards the year of about 2016, we see that the exchange rate was just below 2.2 Singapore dollars to the pound. And at this point, Brexit occurred. And within a few months, the exchange rate went down to about 1.8 and has really hovered around 1.8 for the last few years. In fact, at the moment, I was just checking today, it's at 1.68, which is over a 20% swing since the Brexit referendum and over a 30% swing since 2007, which at the end of the day, if you're earning Sing dollars, which I imagine most people on this call are, it's like getting a 20 to 30% discount. So from an exchange rate perspective, there's really been no better time, at least in the 27 years I've been in Singapore, to use Singapore dollars to invest into a UK property. Oh dear. Okay, I don't know if it's a lag. Let's see if I can, okay. I'll use a different way of scrolling through. Hopefully that works. Okay, so here what we've taken is a snapshot over the last 12 months. The middle bar shows the Singapore to pound sterling change, which is just below 11%. And when we look at the bar on the left side at 9.8%, this is the UK property price appreciation. That's the average price appreciation when this snapshot was done in the last 12 months. And when you just add those two together, the change in exchange rate and the price appreciation, that's roughly a 20% swing in the advantage of an investor if buying in Sing dollars. Now this, and I should say, excuse me, the graphs that I'm preparing and showing you today have come from both One Global Labs, our research department, but also kindly from JLL's research department that I did a presentation with just over a week ago. So in many respects, we're blessed by having the research from both One Global and JLL, and I've tried to take the best of both worlds. So again, a thanks to JLL for allowing us to use some of their slides today as well. Now, this slide here, when I first looked at it, I had to go back to our head of research and I just double checked saying, look, is this correct? Basically, what we've got here is, I think, about 10 or 11 snapshots at different points in time that we can see below, whereby the UK introduced an interest rate hike. Now, most people would make an assumption that when interest rates go up, interest of property starts to diminish. And what this graph shows is every time there's an interest rate hike, the black line shows the price movement a year after the interest hike. The gray is 2 years after the interest hike, and the brown is 5 years after the interest rate hike. And what's amazing is that apart from this one small blip in October 1994, we see a consistent trend whereby prices have continued to go up even when interest rates have gone up. Now, it's true that very often the volume of transactions can go down, but when I speak with clients at the moment, their concern is interest rates are going up. I'm sure Scott may touch on this more, but when we go back to the end of last year, the base rate in England was 0.1%. It was the lowest in over 300 years. It couldn't get any lower. When we look at the last, say, 25 years of interest rates, the overall interest rate environment is still very low. I remember 20 odd years ago paying something like 7% interest rates on my mortgage. Today, you might be looking at, who knows, 3.5%, 4%, 4.5%, depending on what kind of mortgage you take. So I think, when we look at facts and data, yes, interest rates are going up, but it doesn't correspond with prices coming down. So let's get into London, and more specifically, the capital of the UK, one of the most dynamic cosmopolitan cities in the world, with an extremely robust economy, low interest rates still relative to what they have been in the past. As you can see, a very favorable exchange rate, a huge undersupply of property, which is even more exacerbated in the capital than almost any other part of the UK. A city that has over 500,000 students, which you might ask, well, why is that important in real estate? Well, many students need to rent, and they potentially are your tenants. And many students go on to work after they've graduated in the same city that they've studied in, with a more or higher disposable income. Again, they are very often tenants whilst trying to save up enough to put down as a deposit. Crossrail, the high-speed rail going across Greater London from east to west, has finally started operating. And so what we're seeing is another spike in both rental and property prices, with properties within a 5 to 10 minute walk of a Crossrail station. And the population continues to grow, which, again, I'll go into a few more of these points in more detail. So PwC every year do an emerging trends in Europe, and they rank the top tier 1 cities across Europe based on the investment, real estate, and development prospects for that city. And they use many different criteria to rate the cities. And what's been very pleasant to see is that for 2022, PwC rate London as the #1 city for real estate investment prospects this year, pipping Berlin, which has been there for many years in the last decade. This graph shows different asset classes. The red line is the London Property House Price Index. And basically, one of the nice things that we can see is that it's a very steady growth. And when we compare it to other asset classes, such as crude oil and gold prices, which are far more volatile, it might be that if you know how to work and time those markets, maybe you make more money. But for many investors, especially those people who are conservative, who are not full-time traders, then the London property market offers a very, very good, stable growth over the medium to long term. In fact, when we look back at records going back to the 1960s, roughly speaking, every 8 to 10 years, property prices in London have doubled. Now, here we see the population of London. At present, in 2022, it's round about 9 million. And this is projected to increase up to about 10 million by 2040. And why population growth is important is because ultimately, as more people move to the city, more property is required. And one of the greatest dynamics that impacts both capital growth and rental growth is the supply demand. And if you have a rising population and an undersupply of property, then that's a good basic foundation for sustained growth. Oops. Now, this graph's got quite a lot going on. If we just focus on the gray graph for the moment, the gray bar chart, I should say, and the right-hand axis, which shows the percentage change. And what this is showing is going back to the year 2000, what is the percentage change in London property prices over the last 20 years or so? And we can see in 2002, just in 1 year alone, prices rose by just over 20%, which is quite phenomenal. The 1 year that we see a significant decrease in prices was 2008, and that was attributed to the financial crisis. Coming into more recent years, what we've seen is soon after the Brexit, a lot of people were, and these international investors, listening to a lot of negative news. Many investors decided to sit on the fence, sit on the fence and wait and see. They weren't sure whether the UK economy was going to fall off a cliff. But what we did see is that property prices declined and actually went into negativity in 2018. But what we are seeing is an early signs of a recovery in the London property market. Now, the lines above it, the brown line shows the number of new build developments starts, that is, putting spades in the ground. The black line shows the completions. And if you imagine that, let's say, roughly it takes 2 years to build the average development, it means that when you start putting a spade in the ground, it's not until about 2 years later that that property is built and people can start living in it, and it can contribute to the supply of the property market in that city. And if you look at the brown line at the moment, it's going, let's say, somewhere between about 15 to 16,000 starts. The actual delivery of new builds in 2021 was up to about 20,000. Now, this next graph actually shows, if we look at the graph or the bar on the far right, the local government estimates that London needs about 52,000 units delivered every single year in order to keep up with supply. And yet, when we look at the new build delivery here, it's at about 20,000. So a huge shortfall. Now, it's estimated that 10 years ago, the requirement was about 43,000 units, and 20 years ago, it was about 30,000. So they're having to readjust these figures every single year to cater for the increased number of units that's required to be built and delivered in order to cater for the demand. Now, you might ask, they say, Richard, you said it was 20,000 units that were being delivered. Well, that was in the previous graph, and that is just purely new build development properties being delivered. This bar chart actually shows the combination of both new builds as well as refurbished and resale properties. And that's why we see the figures getting closer to about 40,000 when we look at both the resale, refurbished and new build, but it's still well below the 52,000 that is required. Now, this bar chart actually shows Heathrow passenger numbers. And you might say, well, Richard, why is it relevant to real estate? Well, as I mentioned before, London, and particularly prime central London, is heavily influenced by the high net worth overseas investors. We can see in November 2019, Heathrow was getting round about 7 million passengers per month. And then in May of 2020, when the first lockdown hit and travel was effectively stopped, it fell off a cliff and you're pretty much down to zero. But what we start to see in May 2022 is a strong rebound in the number of people that are now traveling. And correspondingly, we're starting to see a real uptick in property prices in London. In fact, you can see in the top right circle, the average change was 7.8% across London. And we've actually seen 45% increase in the number of reservations year to date from 2022 to 2021. So again, activity levels are significantly up. Here we actually see the sales activity increasing across PCL is prime central London. When we look at the Q2 2021, that was the highest number of sales activity. That's really attributed because it was the end of the temporary stamp duty holiday, and there was a mad rush for many people to take advantage of that. So we see a spike in the number of transactions. But when we look at Q2 2022, this has now surpassed many of the months, especially going back prior to COVID. So again, activity is really strong. Now, the combination of all of these factors that I've really mentioned, the undersupply of property being delivered into the market, the growing population, has created a ratio of buyer demand to supply at a 14-year high. And to put that in perspective, I was reading an article a few months ago whereby estate agents were estimating that for every 100 inquiries, they only had 20 properties available for sales. So again, it reinforces the fact that there's a massive supply-demand deficit. On a slightly different note, when looking at different parts of whether it be London or really any city for that matter, one strategy is to look at a neighborhood that is going through significant regeneration. That might be a major master plan, it might be improvement in transportation infrastructure. But what we see here in this graph is that without exception, if you invest into a neighborhood and get in at an early stage, the overall capital growth will be greater than if you go into the same neighborhood, but in an area that isn't going through regeneration. So one simple strategy to just beat the norm is to look for part of the neighborhood that's going through some major regeneration, which is adding value, get in at a lower price per square foot. And after 3-5 years or however long that regeneration activity is going to take place, ride the wave of that increased value to that real estate. So coming close to the end of my presentation, let's start looking into the crystal ball, look into the future. And here we've got Savills predictions over the next 5 years. The top line is prime central London, and this year they're predicting a capital growth of 8% and next year 4%. So just in the next 2 years, a capital growth of 12%, which is, you know, a very strong capital growth. What we did see during COVID was the outer parts of London actually performed well because a lot of people decided that I'll move out of central London because I don't need to be paying top rents. I'm no longer going into the office, and move to somewhere that's less expensive. We do have hybrid workers that are now working maybe just 1 or 2 days in the office. And so working and living from the outskirts that have good connections into the city tends to work very well. And a similar projection from JLL. Here we see in the red rectangle, they're predicting 7.5% capital growth this year and 5% next year. So a combined of 12.5% capital growth in the next 2 years. And just looking towards the prime central London rental this year, seeing a 6% rental growth. So again, a strong rebound. In fact, these are the rental figures across different of London, but looking at prime outer London, prime central London. And we can see a classic V shape here. Prior to COVID, rents were high. As COVID hit in 2020, people moved out from London, and a lot of people who had properties in prime central London were suffering. Rents came down anywhere from 20 to 25, 30%. But what we've seen in 2021, as London and the UK relaxes their policies, people returning to the city, it strongly rebounded to the point now where rents are actually higher than they were pre-COVID. And working with some of our property management companies, they're saying that people are frequently having to go into hotels or temporary accommodation because there just isn't enough property for rental at the moment. Now, this graph kind of blew me away when I first saw it. It shows the average price of property in Greater London going back to 1980. And if we look at the extreme left-hand side, the average price of a property in 1980 was just £15,000. And yet today, it's up at about £520,000 and increasing. So it just shows again that if you're in real estate, and particularly in the London property market, over the medium to long term, you'll do very well. And if you stayed in for a real long term, then you really will be laughing all the way to the bank. Now, my last two slides can be quite an eye-opener, not just to real estate agents that might be focused on the Singapore market, but also those of you who are on the call today who are potential investors and thinking about, different markets to invest in. And without going into all of the numbers, the big picture here, and I've used some very generic assumptions, but if we make the assumption that an entry-level condo these days, probably in the outer skirts of Singapore, would be around about $1 million Singapore dollars. In the UK, outside of London, an entry-level property, when I convert it into Sing dollars, could be about 270,000. So the ticket price for a private property entry level in the UK is already significantly lower. But when we factor in a second property, the government has brought in the ABSD, which even for a Singaporean is now at 17%, on top of the basic, which roughly speaking is about 3%. So you're looking at a 20% stamp duty in Singapore for a second property, and even higher, obviously, for a third property. Whereas the UK, the blended average would be round about 5% on one of these entry-level properties. Now, the loan to value that a second property will allow by MAS is just 45%. So you have to put a 55% deposit down. Whereas in the UK, irrespective of how many properties you've got, they will assess you based on your credit profile, but it's very realistic to be looking at a 70% loan to value. There's also no TDSR. Again, I'm sure Scott will go into this on lenders if you go with a UK lender or a bank there, whereas obviously it does impact your TDSR here in Singapore. But here's the big one I really want people to focus on here. How much money do you need to put into what I'm calling here an entry-level property of $1 million? Well, if we're looking at a stamp duty roughly a 20% on $1 million, that's 200,000. If we're putting a 55% deposit on $1 million, that's 550,000. So add those two figures together and we get $750,000 for one property. Now, when I look at the UK entry level, based on the fact that the ticket price is lower, the loan to value is higher, and the stamp duty is a lot lower, the amount of cash I would need to buy one second investment property in the UK is approximately 94,500. Well, if I was to take 750,000 and divide it by 94,500, I could get over it'd be about 7.5, almost 8 properties for the same amount of cash as one property here in Singapore. That's the big picture I want to emphasize. I've got some other numbers here. When calculating, roughly speaking, how much cash could it produce, the Singapore property, roughly speaking, came out $179 of positive cash flow. bearing in mind that the mortgage here, you have to pay what we call principal and interest, whereas in the UK, we can get interest-only mortgages, which means the amount you're servicing each month is a lot lower, which means that the property potentially can generate a lot more positive cash, even though you're not paying down your mortgage. And then if I flip over to this last slide, again, I'm not going to go through all these numbers, but when you throw everything into the mix and say, well, look, should I put all my eggs in one basket for one property in Singapore? Or if I was to learn a little bit more about the UK, would it be a wiser choice to grow a portfolio of 7 or 8 properties with the same amount of cash, which will generate me more positive cash flow? And ultimately, when we look at the bottom line here, the net ROI, so how much cash am I putting into these investments and how much am I generating at the end? We can see that based on my assumption, and this is obviously a major assumption, I've just taken the assumption that in both countries, all properties double over a 10-year period. Well, that may or may not happen, but I've just taken it for both countries. And we look here that the ROI for Singapore is 139% over 10 years, which, you know, averages at 13.9% a year, which is still a decent return. But when we look at the UK at 276, that's almost double the ROI for the same amount of cash that's been invested. So hopefully that leaves you with food for thought today. What I would encourage is that anybody on the call today, if they wish to co-broke as an agent, then, you know, we're more than happy to do so. For any investors on the call today, again, more than happy to have a one-to-one call, and I'm sure later we'll have opportunities to answer questions. So I apologize, I've run over time a little bit, but I hope that's been useful, and I'll hand back to Sam now. Thank you. Thank
you, Richard. Very insightful. Thank you very much. Next, I will have to bring in the lady speaker here, Micah. It's all yours.
Hello, hi. Thank you, Sam. Thank you, first of all, for inviting me to talk to your network today. And Richard, I thought that was very, very interesting. And especially that last slide, I now really understand why we have so many clients based in Singapore. It all of a sudden, it just, everything just connects. So I'll be talking to everyone today about how to best structure the investment. So at GetGround, we specialize in the setting up and the managing of property holding companies. And buying through a property holding company has become really, really popular in the UK in recent years. And these property holding companies come with quite a few benefits. So today I'll be talking to you about how the market has shifted from investors buying from personal name to buying through a company structure. We'll highlight some of the key benefits of these property holding companies, these special purpose vehicles. Then we'll break down some of the taxes, and we'll talk briefly about how GetGround can assist you or your clients with setting up these companies. So first, I wanted to talk about how the market has shifted. So what we can see here is how many new property holding companies were set up in the UK. So buying through a company structure is not something new. It has been done for years. And each year there were anything between 5,000 and 10,000 companies set up. Then from 2015, we can see that there's a strong increase. In the last 3 years, we can talk about a very obvious market trend. So the majority of UK investors are now, in fact, buying through a UK limited company. Now, what happened? Why this change? Well, in 2015, during the UK budget announcement, the UK government announced that they were going to phase out the ability for investors to offset their mortgage interest from their tax bill. And that would come into place in 2017. And that was a new legislation called Section 24. Now, for most investors, the mortgage interest is the biggest expense to the investment. So, of course, losing the ability to offset that from the tax bill has huge implications on your investment return. Now, this was probably the government's biggest and boldest move to try and encourage investors to go down this company route. So I know in the past in Singapore, it was quite popular to buy investment property through companies, and the government didn't like it. So I think they may have increased corporate taxes. The UK government is the complete opposite. They want investors to go down this company structure route because, first of all, they want to professionalize the rental market even further because the rental market is such a fast-growing market. Individuals in the UK are renting for a much longer period of their lives now. And I think in London, the average age of a first-time buyer 20 years ago was a late 20s, whereas now the average age for a first-time buyer in London is early 40s. So there was a real demand from the government to professionalize the industry even further, but also they wanted more transparency and visibility. So companies by law has to file their taxes each year. So by having companies hold these properties, companies have to declare their income, and therefore the correct taxes are being paid each year. And that's kind of where Section 24 came from. And it was definitely successful, as we can see here. So in 2019, there was a 24% increase of new companies being created. The following year was another 23% increase. And last year, there was a record number of new companies being set up for the sole purpose of property holding. So in fact, 65% of every single investment property bought in the UK during 2021 was bought through a company structure, and that was only 10% before the announcement of this tax change. Now, that also meant that financing has become a lot easier, but as Scott will talk to you later on about the mortgages, but almost a third of every single buy-to-let mortgage is now in name of a company. So there's 270,000 active property holding companies in the UK today. And if you look at the numbers mentioned before, it means that almost half of these companies were set up in the last 3 years only. So it's a really fast-growing market, and these are really numbers that we cannot ignore. Now, other than Section 24, there are some other tax efficiencies as well that we'll break down on the next slide, so we'll park that for now, but it also creates limited personal liability. So the company will own the property, the mortgage will sit within the company name, so there is no TDSR, as Richard mentioned before, but we also work on a very unique model, and that is that each company will only hold one property. And essentially what you're doing that way is you are putting a firewall in between each investment. So if one investment property doesn't really perform very well, or you have some issues with your tenants and the bank wants to repossess the property, they can never ever touch any of your assets because they're all ring-fenced by its own legal entity. So that's a very, very safe way of investing, especially if you are building your property portfolio. And it's also a lot easier to buy and sell with other people. So if you wanted to buy with a business associate and one of you injects more cash into the property than the other, then that's how the shares are also distributed. So the shareholders agreement and the owner's loan document will outline exactly who owns what. So again, it's a very safe way of investing. Then it's also a lot easier to manage your estate and inheritance planning. So inheritance tax can scare off some investors. There's absolutely no reason for that because everyone is entitled to an inheritance tax-free allowance. But these company structures do offer a way of managing that much easier because the mechanism of gifting shares is far easier than the mechanism of gifting property. So a share transfer can be handled in a couple of days. It's very cost efficient as well because you don't need to get solicitors involved. You would only be paying 0.5% stamp duty on the value of the shares that are being gifted. So you can gift multiple times and you can slowly resign from a company and get your children involved. And if you've gifted shares the period as 7 years have passed, then no inheritance tax is payable on that gift. So it's a very good mechanism to manage your estate and inheritance planning. And then there's a very well-developed mortgage market, which again, Scott will talk to you about later on. So you could improve your investment return up to 66% simply by buying through a company. And that is all calculated through the taxes. So I'll try and break it down as easy as I can. Tax is quite complex. It can also be confusing. But the easiest way to see the whole investment journey is to break it down in 3 different stages. And that is the point of purchase, then the period of ownership, and the point of sale. So the first tax that's payable is stamp duty land tax. Stamp duty land tax in the UK is a lot lower than what it is here in Singapore. And there's no difference on the rates for companies as it is for individuals. So there's no advantage and no disadvantage on that very first stage of the investment journey. But then during ownership, there's 2 key differences. First one is what triggered this change in the market, and that is that companies can offset their full mortgage interest from their tax bill. Individuals get a basic rate credit only. The other difference is that companies pay corporation tax and individuals pay income tax. Now, income tax will arise the more money you earn in the UK, and it starts with 20%. The next step up is 40%, and the maximum rate is 45%. Corporation tax is a flat rate of 19%. So there's a small saving there. Eventually, if someone is building their portfolio, it could be a significant saving. Then there's also 2 very tax efficient ways of taking money out of the company. First of all, you can repay the owner's loan, and the owner's loan is your down payment. So when these companies set up, these companies don't have any money, so they need to borrow money from their company directors in order to purchase this property. And this loan is looked as a director's loan, an owner's loan. So of course, you can take money out by repaying the owner's loan without paying any additional taxes because it is not an income. The company is simply paying off its debt. Now, you can also take a dividend income for any Singaporeans. The recommendation is to take a dividend income because there's no dividend tax for non-UK residents in the UK. And in Singapore, there's also no dividend tax on overseas income. That means that your owner's loan pots will remain intact. And when you sell the property, the owner's loan, the outstanding owner's loan is then offset from your tax bill because it is an outstanding debt. And that's another way of lowering your tax bill at the point of sale. Now, if we move on to the point of sale, there are some advantages to companies as well. So first of all, if you are buying a property in your own personal name and the property is sold, then you will be paying capital gains tax. Capital gains tax is either 18 or 28%, and where the threshold lies is £50,000. So if you've made a gain of over £50,000, which is very likely with UK property, you'll be hit with this 28% capital gains tax bill. Now, if your company was to sell the property, companies only ever pay corporation tax. So that's a very big saving on exit. Now, with our model, this one property, one company model, there is a second way of selling, and that is by selling 100% of the company's shares. That comes with a couple of advantages as well, both to the seller as to your buyer. Because if a company is being sold, it means that there is no land transaction taking place. So your buyer does not have to pay any stamp duty land tax. The only thing they'll be paying is 0.5% stamp duty on the value of the shares. So of course, that means that your property is far easier to sell because your property that's held by this company is much cheaper to purchase compared to the exact property in the same building next door. So that's your exit strategy, easier to achieve. And of course, you never have a good investment if you do not have a good exit strategy. So it's easier to sell your property. But what we have seen in real life is that the saving on stamp duty land tax was equally split between the buyer and the seller. So you will sell at a higher price. Your buyer is still saving thousands of pounds. So that's a win-win situation. But also, you are paying a lower rate on capital gains tax because capital gains tax in the UK is actually this lower rate, 10 or 20%. That is the standard rate on capital gains tax. It is only investments, residential property that incurs this higher rate. So again, you're almost being penalized by the UK government for purchasing your property in your own personal name. So I'll just recap on the taxes. So companies can offset their full mortgage interest from their tax bill. Companies pay lower taxes on the income. There's very efficient ways of taking money out of the company without paying additional taxes. There's 2 ways of selling, either selling the company shares or selling the property out of the company, but whichever way you sell the property, you save a significant amount on taxes on exit. And this is the main reason why 65% of all investors last year have bought their property through this company structure. Now, how do we as a company then slot into all of this? So we are a technology company and we are fully supported by the UK government. And the UK government has actually in part funded our company, but most importantly, they have allowed us to build our technology and plug it directly into Companies House. And Companies House is the equivalent to Accra here in Singapore. So we can set up companies within 48 hours. So first of all, we will help the client with setting up a UK limited company, but everything is done online. So you can create the company on our website and create your profile. And then within 48 hours, we will have the company up and running. We would also provide all of the legal documentation related to the structure of that company. We will handle the web filing with Companies House, and we also open a UK company bank account. And this UK company bank account is then what is used for your rental income, your mortgage repayment, and all of the expenditure related to managing that property. Because once the company is set up, we then take on the role of company secretary, and we will do everything that is required to manage that company. So we have a view-only access to the company bank account, and that allows us to then look after all of the accounting, the bookkeeping, the company auditing, but also the annual tax filing. So not only takes it half an hour to set up a company, and has a company, is it active within 48 hours, the client will also have a UK company bank account. And these days from overseas, it's more or less impossible to set up a UK company or UK bank account in general. So this is a very sort of hands-on solution, or hands-off rather. Everything can be done online, and we will look after the full management of the company. So you don't need to employ a separate accountant anymore to handle your tax filing. Now then that leads us to our fees. So we are 10 times more cost effective than any alternative in the market. There's two components to our fees. Firstly, we have a one-time setup fee, and that gives you your fully operational business. So we would charge £499 plus VAT, and that gives you your fully operational special purpose vehicle, including the legal documentation and the UK bank account. Now, people would only pay this for their first 2 companies with us. So this structure also works for portfolio landlords. Then the second component to our fee is the annual running cost, which is £228 plus VAT per year. And that includes all of the accounting, the bookkeeping, the tax filing, all of the secretarial services, as well as our office address being used as the registered office address. Now then finally, some of our credentials. So I've mentioned some of these before. So we are funded in part by the UK government via HM Land Registry. And this is the only reason that we can set up these companies so quickly. Then we're also registered with the Financial Conduct Authority, the FCA. And this means that the part of our business that handles the money is all regulated, but it also means that we can handle share transfers. And of course, that is very important if you wanted to mitigate your inheritance and estate planning. And then finally, we are also a recognized supplier for the National Residential Landlord Association. So that's all from me. So I guess I'll be handing back to Sam. Thank you very much.
Thank you, Bianca. Thank you very much. Bianca, that's very interesting to know so much. We have questions are coming in, but I think we will put it right at the end. We let Scott to finish off. And then after that, we have a Q&A session. So Scott, you are there. It's all yours.
I am. I'm ready. Thank you very much. I appreciate everybody taking the time to be here and joining us this afternoon. Hopefully my slides are on the screen, Sam. Or Bianca, give me a nod.
Yeah, I saw you.
Yeah, that's great. Thank you very much. Okay, so I appreciate we're already running over slightly. So I've cut down some of the slides as we've been going along this afternoon, just to make sure I can be as succinct and to the point as possible to let you know about. Richard has given you the reasons to buy in the UK. Bianca has shown you one way that you or your clients can own a property in the UK. And now I'll show you how you can finance that property in the UK for yourself or for your client. To give you a bit of background, I've been doing this for 25 years, but Capricorn has been open since 2005. We are the largest broker in London, and we are the biggest introducer of business to many of the banks throughout the UK. From your client's perspective, there are 10 of us in the international team, 3 of us based here in the Singapore office, there's 4 in the Hong Kong office, and then there's some in the London office as well. Bianca already mentioned the FCA, which is the Financial Conduct Authority, the UK version of the MES, and through our London office, we are fully regulated by them as well. And as you can see there as well, Capricorn Wealth Management, we've got a 5-star rating from our clients on Google. So we're very proud of that, and hard to maintain a 5-star rating, but that's what we do. So what's going on in the UK mortgage market right now? Both Bianca and Richard have already highlighted that interest rates have come up from historic lows. Are there more increases to come? Yes, I think that's the conclusion everybody's come to. Rates are going to start creeping up again. However, this is not unusual. The rates are going back to normal. What we have seen for the last few years has been the unprecedented rates, as Richard highlighted. So things going back up again are just things normalizing, and there are still some very good mortgages to get out there that make property ownership competitive. What has changed is lenders are getting more interested in AML, anti-money laundering. They will ask for a lot of documentation for a UK mortgage application. But once you get through that stage and it's been done right first time, which is what we always endeavour to do with our clients, then things tend to be a little bit smoother. There is a 32 banks out there right now who are lending into for non-residents buying in the UK. So whether you're British, whether you're Singaporean, whether you're any other nationality, most banks will just treat you as a non-resident, and they have a specific set of products and mortgages available for you. New lenders come into the market, old lenders leave the market, but the product ranges within those lenders are always updated. So we keep a constant eye on that to make sure we're getting the best rates we can for our clients. Because we're so large and because we give a lot of business to these banks, we don't always get discounted rates or cheaper mortgages. That doesn't tend to exist anymore. But what we do get are cheaper fees. So the processing fee and the administration fees that banks charge tend to be cheaper for Capricorn clients. And also, we tend to have a designated team within the bank who just looks after our applications. So therefore, processing times can be quicker. Just to give you some idea, that's the kind of banks that we deal with. If you look at the top right-hand side and the bottom left-hand side, the private banks and the international banks, that's the lenders that we'll go to. That's the people we'll approach on behalf of you or your client to see if we can source finance for you. You'll see some familiar brands there. Top right, Standard Chartered, for example. Of course, that's not Standard Chartered in Singapore, because Standard Chartered in Singapore does not do mortgages for the UK, but we will use one of their branches closer to the UK that can finance that. Same in the bottom left, you might see HSBC there, but again, that's not going to be HSBC in Singapore because they don't do mortgages from Singapore for the UK, but we can use either a UK branch or we can use a branch outside of Singapore to help finance that. So lots of choices, lots of different lenders that we can approach. What do the banks look for from you or your clients? Very simply, you're looking for some proof of income. That might be the property income or your salary. Either way, or your self-employed earnings. If your client or you are self-employed, then it would be an average of your NOA for the last 3 years. They will use that to decide your income level. The way that UK banks work on the interest rate they're going to charge is purely down to the loan to value. Now, the absolute maximum that you can borrow in the marketplace at the moment is 80%, 80%. But there's only one bank that will do that. And because there's only one bank, they do tend to charge a little bit more than everybody else. If you can borrow 75% or less, most of the other banks become available to you. If you or your client already have a UK property, one thing that is allowed to happen in the UK that does not happen in Singapore is that you can refinance that property. And if the property value has increased, you can release the cash that was locked into the property. You can release that cash out and use that for additional investments. Guarantor and third-party mortgages are available if required, and all lenders have, for an investment purchase, what's called rental income stress tests. Put very simply, absolute minimum, the rental income that you will expect from the property has to be at least the same as the mortgage payment. The higher that margin can be, if the rental income is 125% or 130%, the higher that number, the easier it is for the lender to say yes. What do we look for? What are the sort of terms and conditions and the rates and the fees? Buy-to-let interest rates right now range from about 4 to 4.5%. Some lenders are slightly cheaper, some are a little bit more expensive. but that's where they sit. Residential mortgages are available. So if you are moving to the UK, or you have a family member, or your client has a family member who's going to live in the property and it won't be used for profit, you can actually organise a residential mortgage and you'll get that at the same rates as someone who lives in the UK. The lender's arrangement fees tend to range between 1 to 1.5% of the amount that you're borrowing. And the maximum loan tenure, again, if this is for an investment property, the maximum loan in the market is 35 years, 35 years, or age 85, whichever one comes first. As Richard alluded to, interest-only lending is available. Let me just reiterate how that works. When we go back to the previous page and we said interest rates are decided by the loan to value. So if you're borrowing 75%, 70%, 60%, the lender will have a rate that is specific to that loan to value. You then choose how you're going to pay back the lender. Are you going to do principal and interest or interest only? The rate stays the same. There's no extra fees. There's no extra charges for interest only versus principal and interest. It's purely down to what suits you and what you need for your cash flow and this investment. Just like in Singapore, most lenders have lock-in periods. So if there's a special offer, it may be a lock-in for 5 years or a 5-year fixed rate or something like that. But even during the lock-in periods, you are allowed to make additional payments if you wish. So even on an interest-only loan, if you were looking to overpay to reduce the principal, you can do that, usually up to about 10% per year. This is Bianca's page, really. So we can arrange mortgages for corporate structures. It's very possible. We encourage all our clients, if they are going to do it this way, to do it through a UK limited company. It is possible to do it through Singapore companies or BVIs or special purpose vehicles established in other parts of the world. But you really have to be looking at a loan value of at least £1 million or more for those things to go smoothly. Anything under £1 million, UK limited company is the way to go. And when it actually comes to the application process and the mortgage process, it's just 2 extra sheets of paper. So company paperwork, 2 sheets, proof the company has been established, and the certificate from Companies House, which GetGround allow you to download online from their portal. And that's it. Everything else is the same as a normal mortgage application. So quick summary, the actual application process, myself or one of my colleagues would do a full analysis, and a recommendation would come from us to the client. We can get that mortgage pre-approved. That usually takes a day or 2, depending on the lender, but some are instant, and we have back-end access to their pre-approval calculators. The client says yes, the lender says yes, we submit the documents. During the process of the application, the bank will send a surveyor out to the property to check its capital value and to check its rental income value. The mortgage offer is then produced, and that will be 6 to 8 weeks later in total. And then depending on the lender, the mortgage offer is valid for 3 to 6 months. Now that's a key difference to Singapore. So what does that actually mean? If your client is buying a property off plan and the completion date, the TOP date, is going to be way in the future, we do not start the mortgage process until 6 months before completion, TOP. If the property is already available and the property is already on the market, then we start straight away. Why? The valuation. There has to be a physical property for the valuer to check and go and inspect. So the other upside to that, which is slightly different in Singapore, of course, with the UK mortgage, you don't make any mortgage payments until you've got the keys. So the day that you take that property ownership, that's when your mortgage starts, not many years in advance. So that saves clients a lot of money, just means they only have to pay their deposits in the early stages, and there's no cash flow need until the property is actually in your hands. And then after the mortgage offer comes out, the solicitors usually take another few weeks just to finalise everything. And then the property is yours. So that's it. I've made my section as brief and as to the point as I can, but more than happy to answer any questions if they come up. Over to you, Sam.
Thank you, Scott. That's quite sharp and sweet and short. No, but I guess we have come to, we have heard all the 3 speakers, and time is for us to do some Q&A. I see there's quite a number of questions. So we'll go through one by one. We will invite Bianca, Richard to come back. And we'll go through question by question. But before that, let me share this screen. All right. So this is one that this is a slide you should snap a picture, because there are three of our distinguished figures. Their numbers are all captured here, so that you can actually carry wherever you go, and you come across, you just go to your handphone, you just flip open, you can see them straight away, right? You can contact them directly in any way. Now let's come to the question. First, this is more okay. We have a friend from Philippines, I believe. Nerissa, how to be an agent? Okay, I guess he's asking how to become an agent, but I think we can take that from later part. But I guess perhaps Richard, you can tell us how, if let's say we have a client in Singapore or in another country who have a property in UK and they want to buy, they want to sell, or they want to buy a new property, how should they reach out to you, and what will you do from there?
Sure. Well, certainly that's what I do basically day in, day out is help clients understand the UK property market. And generally what I will recommend is to either have a virtual call, or better still, if in Singapore, meet face to face, which we can do these days, and really better understand the investment goals, and of course answer any questions. So I mean, this particular question is, my wife is a British citizen and a Singapore PR. What's the duty that we can expect, please? Is still at 5% if we use her name only. So I'm not a tax specialist, but I'm also a British PR here in Singapore, and I have bought and sold property in the UK. So I can give some indication just to give an immediate response to this question. Actually, irrespective of whether I'm British or non-British, the key factor is, am I a resident of the UK or non-resident? Well, I'm a non-resident. Likewise, Shashi, your wife, is also non-resident. The other question would be, are you buying it as your own personal property to live in, or are you buying it as a rental property, as an investment property? Now, there are different tiers of stamp duty depending on those parameters. So I'm going to make an assumption that you're non-resident and buying an investment property. And even then, the stamp duty tiers, that they go up based on the price of the property. So I can't give you just an exact answer. What I would suggest is, if you'd like to reach out or give me your email, I can forward you a chart that shows, based on the price of the property, non-resident and buying as a investment property, what those stamp duty thresholds are. Again, to give you a ballpark figure, if it was an entry-level property, you're probably looking at about 5%. If you're looking, I mean, the stamp duty goes up. I mean, as you get over £1 million, it goes up quite significantly. So again, it really depends on the price of the property then. But for an entry level, you're probably looking at around about 5, maybe 6% stamp duty. I hope that gives you some indication, but feel free to reach out to me.
Yes, Shashi, there's a number there. You can reach out to him immediately. Just send him the text. I think he can follow up with you immediately. This is one guy that always reply his message and call. I know.
Okay.
Next two question, I think that's for Bianca. Ma'am, do you want to take over? Yes.
Yes. So the first question is from Miriam. The question is, what's the expense involved in the setup and maintenance of a company in the UK, i.e. accountant fees, corporation fees, legal fees? So I think you may have typed this before I talked about this during my talk. So the setup fee of the company is with GetGround, with our company, is £499 plus VAT, and it gives you your fully operational business, including the legal documentation, the registration with company's house, and the company bank account. And then the ongoing running cost is £228 plus VAT per year, and that includes everything else. So we've opted for a very transparent and a very simple fee structure. The accounting, the bookkeeping, the tax filing, and so on, all of the secretarial services are included in this £228 per year. So I hope that has answered your question. The second question for me, actually, I think there's a few more for me. I'll just go through them.
Yes.
That's okay, Sam. So this is from an anonymous attendee. So current personal ownership can switch to corporate ownership. What are the costs and what is the process like? What are the banks you recommend? So you can switch from personal ownership to company ownership. You can do this. However, it could be a rather costly exercise because this is seen as a sale and there's a land transaction taking place. And that means that stamp duty land tax will be triggered, and also potentially capital gains tax if the property has increased in value. It's exactly the same process if you were to purchase a property. You'd need to get solicitors involved. It's just a standard transaction, but you are the seller as well as the buyer. It's not something that we would usually recommend people doing because of the cost involved. And then the second part of that questions are what are the banks you recommend? I think that is probably one for Scott. Do you want to take this for now, Scott, and then I'll carry on with the other questions?
Sure. If the question is what banks for companies, there's about almost a dozen at the moment. So about 12 banks that will do company mortgages. So in actual fact, we don't recommend any. What we do is an analysis of all the banks that are available, personal or company structure, and then provide you with the quotes from the best so that you can make a decision.
Oh, thanks. Bianca,
Okay, so
the next one.
Yeah, so the next question from Rose, do we have a choice of banks for the account opening? The simple answer to that is no. The reason for that is that we need to have a visibility to your bank account in order to apply technology to the accounting, the bookkeeping, and the tax filing. So this is the only reason that we can keep our cost this low. As soon as you have your own bank account, it becomes a very manual job. Because you'll need to send bank statements and receipts and invoices. And this is exactly why accountants are so costly. So because these bank accounts that we open are fully integrated within our technology, it means that first of all, we can open them really quickly within a matter of days, but also we have the visibility to that. And that means that we can actually manage your property or your company very efficiently. The bank account is with a provider called Modular. Modular is owned by Revolut. Most people are familiar with Revolut. So the next question, again from an anonymous attendee, Bianca, is there a requirement for a company setup be operational besides buying a property under company? I'm not entirely sure what is meant by that. For one who have bought a property under personal, does it make sense to transfer the company setup? What is your advice? I think we've actually answered that in one of the previous questions. It's usually not the recommendation to change ownership because of the cost involved, but it can be done.
I think the first part of the question, Bianca, is about if you have an existing company that already operates and does other things, can you use that company and still get the advantages that you talked about?
Oh, right. Well, you can use any company to purchase a property. It's not something that we can assist with. We can only set up new companies where individuals are shareholders. The reason for that is that we try and guarantee trust and transparency to the market. And as soon as you add different layers into that, you lose that trust and transparency. So yeah, it's not something that we as a business allow, but you could do that elsewhere.
And just as a slight overlay to that, I think from a lending perspective, banks prefer it to be clean and easy. So like a get ground company is very specific. It's set up for one purpose, which is to buy the property, get the mortgage, finances are in place, very simple. Like Bianca said, the more layers and complexity that go on top of that, the harder it is to find a lender that will do that at competitive rates.
Richard, next one. What are the costs when you're selling a UK property aside from the CGT? You want to try? Unmute yourself, Richard. Sorry.
Yeah, there will be an agent's fee. That will typically be, say, around about 1 to 1.5% in the UK. You've got your capital gains tax that you'll need to settle. I think that's within 1 month. Really, those would be the main exit costs. If anyone else wants to jump in, please help out. But I can't think of any other specific costs there.
Probably I can ask a question, but maybe tag to this. I think we'll direct to Scott. Scott, is there a redemption fee if you were to sell property earlier and then the banker require you to make some payment?
It depends on the loan that you took in the first place. So the same as Singapore. If there's a special offer, or maybe you chose a 5-year fixed rate, that may have a lock-in period. And yeah, if you fully redeem the mortgage within the lock-in period, there would be a fee. But if that's a client's plan, we can find lenders that don't have lock-in periods, and we can look at those too. So
if there is a fee like this, redemption period, what do you reckon to be? I guess it must be various from size to size, but off the mind.
Yeah, absolute maximum at the moment that I've seen is 5% of the mortgage balance, and that goes all the way down to 1% or maybe just an administration fee.
Okay.
I think the next question is for me.
Scott, this is for you.
Yeah. So are you allowed to refinance for better terms and rates? The simple answer is yes. And that's part of the process and one of the reasons why we've been doing this for such a long time. Vast majority of our clients are existing clients who refinance on a regular basis. We build into our CRM to get in touch with you 6 months before the end of any special offer that you're enjoying. And if there's no lock-in period, we'll get in touch with you at least once a year to review anyway. And then if there's a better if it makes sense to change, then we'll help you arrange the change. I think the next one's for me as well. Can I use a Singapore family trust with a BVI holding company to purchase property in UK? The answer is yes. However, as I mentioned during the presentation, it has to be a pretty sizable loan if you want to get competitive rates and terms. I would suggest £1 million or more. Maybe there's a couple of lenders that would start at £500,000 or more, but for the full range of market, 1 million plus. If it's less than that, just set up a special purpose vehicle through Get Ground.
Just to add on to that, Scott, when you're saying that the size of the investment amount, can it be multiple purchase of property or just single?
Oh, excellent. Good question, Sam. Yeah, multiple would be okay, as long as it adds up to that value. What we're getting into there is the bigger the package, the easier it is to ask a lender to do as a favor. That's basically what it boils down to. Got to make it profitable for them as well.
I see. Area, that's for you, Bianca.
Yeah, so the question is, not all banks lend to companies. Does Get Ground help set up UK limited companies for buyers to qualify for loans? Yes, so our companies are all specifically designed and structured so they work with lenders, and so they can be sold. So the bank accounts that we set up and the companies that we set up, they've all been pre-approved by the majority of lenders out there. And there's a lot of specialist banks that will only lend to companies. So far, we've not come across any issues, but then we obviously work with Scott at Capricorn a lot, and they have a very large pool of lenders on their panel that specializes in corporate loans.
Bianca, maybe I just want to add on to this question. So when Get Ground is trying to do the help at the setup and your formation of the directors, do they come into a question or something like a stress test for you to decide whether to put out the loan?
Well, that's a question for Scott, really.
Okay.
Scott, do you want to take that?
Okay. So yeah, so Bianca would set up the company, then you've got your directors and your shareholders within that company. From that point forward, everything else with the lender for the loan is the same as a normal mortgage. For most company purchases, the bank will want to do the underwriting on anybody who's got more than 25% of the shares, or is a director, or is a director. So from that perspective, it would just be like a normal mortgage application.
Okay.
If there's 2, 3, or 4 people, passports, bank statements, payslips, existing property information, etc., etc.
All right, thanks. Richard, are you a NAR member?
Can you enlighten me, NAR, please?
I think it's a US-based, a National Association Realtor, something like this.
Right, no is the answer. I do hold a license here in Singapore under One Global Property Services. So no, I'm not an NAR.
Okay, we move on to the next one. I have a unit in Kent for 9 years. Wow, it's holding on for 9 years. Do I pay any tax if I sell the unit? Example, capital gain tax or income tax? Richard or Bianca?
Well, the straight answer is yes. You are going to be almost certainly paying a capital gain, assuming the property's made a profit. I imagine if you've had it for 9 years, it will have done very well, actually. Income tax, well, yes, assuming that depending on your mortgage, I suppose, and how much you're servicing for your mortgage, if you're making operating income profit, then there's potentially some income tax to pay there as well. But
Okay.
again, I'm not a licensed tax advisor. I can put you in touch with tax advisors if you need some real specialist help.
Yep, the number is there. Call him up and he will refer to you. Next one, Bianca, I think this is for you under company ownership.
Yes, a question from Lynn. A property now under personal name, can we still convert this to company ownership? If yes, what is the cost? It was one of the previous questions. Yes, you can change, but it would trigger stamp duty, land tax, and it could potentially trigger capital gains tax if the property has gone up in value. So again, it's usually not a standard recommendation because of the cost involved.
Bianca, allow me to add on to this question. What if there is a multiple property purchase? Could we put them under one company ownership, or do you suggest that we split up one property per company?
So we follow a one property, one company rule because we believe that that gives you the biggest protection because you're ring fencing each asset. Lenders really like it, but it also gives you more flexibility and the best investment return. But what we can do is we can set up a holding company and then have subsidiary companies underneath the holding company, and those subsidiary companies will then only hold one property. So you're still having a group. And you can apply for group relief. You can offset losses against the different subsidiary companies. So it gives you the flexibility as well as the protection, but you would still have them under the same group. So that is something that we can do. Sure.
Now that leads me to another question. So if we have a company, then you have directors. Do you pay directors' fee as income tax on their?
So we actually, as part of our business model, we wouldn't allow, well, the companies that we set up, we wouldn't allow for that. And the reason is that the companies that we create, they're special purpose vehicles. So they cannot employ anyone. That or directors can also not take a salary. Salary would then be, you would have to pay income tax anyway. So the reason why we haven't chosen to go down that route is that there's very little benefit to it.
Thank you on that. Next one, Richard. What is the management fee for property?
It does vary from one place to another in the UK. As a general guideline, London is about 12% of your monthly rental. Outside of London, about 10%. But again, it varies from company to company, but that's pretty good ballpark figure.
Mm-hmm. Thank you. Bianca, registered office address, is there a cost?
That's all included in our running costs, so there's no additional fee for it. It's included in the £228 per year.
Thank you. The next one is also for you. Can I put all my existing asset? I think you answered that, but maybe you want to try again?
Yeah, so the question is, can I put all my existing assets held under a UK company into a Singapore trust? If yes, will transfer of shares of this UK company into trust incur any stamp duty? So we wouldn't allow anyone other than an individual to be a shareholder or a director within the company. It is possible, but it requires, you will require an accountant to do this for you. So the cost will be higher. It's not something that we can support with. And because we don't deal with it, I don't have an answer on what the cost would be in moving these assets to the Singaporean trust.
Good, thank you. We have a Filipino friend here. I think Richard. What's the question here? Do I need to travel? Richard, I think you contact Richard directly. You don't have to travel there if the travel expenses is really something that you are concerned. So Richard should be able to link up with you or his connect network there.
We have clients all over the world. You know, I would say the vast majority of the clients don't have to travel. They don't have to one way or the other in order to do a transaction. It really just depends on the client. If they want to go and visit the country, the city, possibly the actual development as well, it's entirely up to them, but they don't have to. We can do everything online and remotely.
Okay, thank you. The next question, what is the annual fee? I don't know which one is asking about annual fee. It's probably talking about Bianca, do you have to continue to pay after the maintenance fee for setting up the account? I guess.
So the ongoing running costs, you just pay that throughout the period that we act as your company secretary. So the £228 will be charged every year as long as we look after your company. As soon as you want to remove the company from our platform and move it to a different company secretary, then you stop paying the maintenance cost or the running cost.
Yeah.
So it's not linked to the rental income at all. It's literally just, you know, we manage the company. It doesn't matter if that the property in the company is worth £2 million or £50,000. Our running costs are the same.
Okay. Yeah, I think that's answered. Richard, there's the next question. I think it's direct at you.
Yeah. So this is basically on, you know, paying capital gains tax on the profit of the property. And she says, I understand that there is an element of valuation of the property that needs to be obtained before one can sell, which I do not understand. So if I've understood you correctly, it was April, if I remember rightly, 2015, whereby overseas investors were then subject to capital gains tax if they sell their property. So if you bought a property before that date, and let's say, for example, you bought it for 200,000 and it's gone up to 300,000, that 100,000 profit effectively wouldn't attract capital gains tax, because it's if you sold it by April 2015. Now, if you were to sell the property now, then ideally what you should have done is get a valuation of the property in April 2015, so you know what the capital growth was at the point of time you bought it up until April 2015, because any capital growth after April 2015 will then be subject to the capital gains tax, which is between 18 to 28%. So yes, if your property was bought before April 2015, it's a good idea, even though you're going back some years, to try and get a valuation of what your property was in April 2015, which would help to calculate how much capital gains tax you'd be paying if you were, let's say, selling it today. I hope that's clear. It's a little bit complicated because of the dates and so on, but again, reach out to me if you want further clarity on that.
Yeah. Generally, we are all housing agents. I think Richard and myself, we are all housing agents. But I think this is a taxation question, so we have to direct to the tax accountant. But I think Richard can help you to find the person, right?
Sure. Yeah.
Rose have a question for Bianca.
So the question is, please reconfirm if these services and companies are not only restricted to London properties or other cities in the UK. We set up companies for properties anywhere in the United Kingdom. So it's not limited to London, England, Wales, Scotland, any properties in those areas we can set up companies for. So our model is specifically designed around the UK property tax system.
Yeah, I guess the next time, next session, we'll be doing probably cities like Birmingham and Manchester. So I think that applies as well. Yeah, Bianca, this one I don't understand what you're trying to say. With Russia, who is the UBO of the Singapore Trust, be an issue in buying property through a BVI company. Scott or Bianca, I think this.
I'll take it. I'll try and take it. So BVI companies in the past would offer people to be anonymous. This is why in the past BVI companies were very popular to purchase properties from, because people would use these vehicles to hide their assets. Also in the past, BVI companies were not subject to inheritance tax. Now that's all changed in 2016. So a lot of these benefits that came with BVI companies don't exist anymore. So buying through a BVI company is a very outdated way of buying. Whether a Russian can purchase, I guess it depends on who the Russian is, where source of funds are coming from. And I think that those are keys. Now, Don, if you are Russian and you wanted to buy a property through a Singapore trust, then have a chat with myself and with Scott, and we can try and find the best way of structuring this. But a lot of it comes down to source of funds, which is something that the solicitor will handle.
The next question is, I think Bianca is again direct at you. So what do you recommend if we're going to set up a company first before committing to purchase?
Yeah, so it depends on what type of property you're purchasing. For the majority of properties, especially if you're buying off plan through Richard's network, there is no need to set up a company in advance, because we can move so quickly and we can have these companies up and running within 48 hours. You don't have to set up these companies prior to this anymore. So once you've identified a suitable property and your offer has been accepted, that's when you will immediately set up your company. You'll ping me a message alongside the setting up, and then I will have your company details. I will have access to it instantly. It will just not show on Company's House until 48 hours later. So identify the property first, make your offer, have it accepted, and then set up the company.
Sure. The next question is, sales tax based on property value determined by a valuer or based on the sales price agreed by the buyer and seller? Richard, you can catch this?
Yes, I'm pretty sure it's basically on the final purchase price. Again, I'm not a tax advisor though. So I'm pretty sure it's whatever price is agreed to, that is what you'll basically pay your capital gains tax on if you've made a profit.
Just in case I'm reading between the lines here, but if of course you transfer the property to each other for £1, then that raises flags, because your solicitor has to register all the buys and sells when they process the sale. So if it's seen to be done under market value, there has to be a justifiable reason for that, and your solicitor has to report that. If the Inland Revenue suspects, they'll just come and look for the tax anyway.
Yeah, thanks. Next one, Richard.
Can I
ask what's the payment schedule for payment?
Okay.
I have no payment.
Let me just read it. I heard earlier that no payment is required until TOP.
That was during my presentation. So I said no mortgage payments need to be made until after TOP.
Yeah. How about the initial deposit? How many percent? It does depend from developer to developer. So if you're buying off plan, that means it's still being built. Typically, you're looking at maybe a 10-15% deposit upon signing a sales and purchase agreement. There might be some progress payments. And then let's say you're taking a 70% loan to value, then if there are no additional progress payments, and let's say you've paid a 10% deposit on signing a sales and purchase agreement, upon TOP, there will be an additional 20% deposit, and then the balance of the 70% would be drawn down on the mortgage if you've got a 70% loan to value. At the point of TOP is also when you pay your stamp duty. So it's not upfront, that's upon TOP.
Good. Last question. Scott, what's your mortgage fee?
Yeah, good question. So we don't charge anything up front. When the official offer comes from the lender and that offer is issued to you or your client, then for first-time mortgage, it's £1,500, and any future mortgages or refinance, it's 50% discount, so it's half price. So £1,500, but if you don't get the mortgage offer, we don't charge.
Okay. Now, final question, Richard. I think that we can arrange with you how we can do this co-broke basis. Singapore.
Okay, what is the agent commission for rental for a landlord and tenant? Okay, yeah, I think probably have a chat with me if you wish to co-broke. We can work out something. So if you have a client, let's say they've already got a property and they want to rent it out, or they want another property management company, we can negotiate a fee for that. The rental for the landlord and tenant. I think I've understood that. Yeah, best thing, reach out to me, and I'm sure we can find a solution, because we do work with various property management companies, and we can arrange a fee for you.
Well, thank you very much. With that, we have attempted all the questions. I guess I'm very happy. I'm now more knowledgeable than before. Thank you for the distinguished speaker, three of you. I think I should call you all the A team for UK property. We will do another round sometime later for Manchester, Birmingham. Is that okay with you guys?
Yes, absolutely.
Absolutely fine. Looking forward to it.
I do not know whether it's any difference, but then I thought we should do one more round. And then, as you can see, we actually reach out to Filipinos, because just over 2 days ago, we have delegates from Philippines came here. So I shared that with them. So I asked them to kind of attend this. So I think the next round we can do is to reach out to the Arena Connects, which IEA have. And also for those who are buying property, who are still here with us, please connect with these three superstars here. They definitely give you a hand-holding experience when you make your purchase property in London, especially. And then for the agents, you're looking to find out more, you really know how to reach out to them. Please go ahead, knock their door. They are always there. They are all based in Singapore. They are easily accessible, and they're very friendly. Just tell them what you need. They will help you to find your way, guide you all the way there. I have a very good experience with them. So I think they will share the same experience. They will extend their hand to you also. So any more question? Last question, any guys? If no more, I think thank you for the time. We will really appreciate for the A team. And we'll see you again. And if your slide, you want to share a slide, you can put, if you guys really need a slide, you can reach out to our administrator. We will actually email to you. I think the speaker have already expressed they are willing to share the slide with me and with you, all of you, sorry. And yeah, we can you can come and ask from us. We can just post to you. Otherwise, this session is recorded. You can go to our website and then pick it up from there. So nothing else. You can give us your feedback to the email. And I wish you all the very best. Thank you. Thank you for your time.
Thank you so much.
Thank you, Richard. Thank you, Scott. Thank you, Baika. Good day.
Bye-bye.
Bye.